Hey, it's Jim, and this is FRM Part 1, the topic on Foundations of Risk Management and the chapter on Principles for Effective Data Aggregation and Risk Reporting. I'm going to go ahead and give you the very first sentence in this chapter. It reads something like this. Effective risk analysis requires sufficient and high-quality data. We could put an exclamation point on there and probably move on, but there's lots and lots of good stuff inside of this chapter. But you might be wondering how this chapter relates to the previous chapters, but I'm going to convince you that the relationship is linear here. Give me just a second. So a couple chapters ago, we did capital asset pricing model, which helped us estimate the required return on a financial asset. That was a one-factor model. Then we moved to multi-factor models with APT. But remember that in both of those models, we needed lots of data. We needed data on external information like inflation and interest rates and yields and GDP and exchange rates. We also needed data on internal information like credit analysis for borrowers, number of ATMs, how frequently those ATMs are being used, portfolio weights, risk metrics, value at risk, all those kinds of things. So this chapter, I believe, is just a great addition to CAPM and APT because those models rely on data. And the question then becomes, okay, if we collect all this data, how are we going to organize it? So there we go, effective data aggregation. And that's essentially what we're trying to do here. So I want you to remember that this chapter is essentially a way for us to effectively use those models, and not just CAPM and APT, but expected shortfall, sensitivity analysis, risk metrics, all those kinds of other things. You'll see that when you go through these learning objectives. Now, you guys know by now that I really enjoy trying to identify the most important kinds of likelihood questions that are going to show up on your Part 1 exam. And if I had to pick one of those four, I'd pick the third one. So we'll spend a good amount of time talking about the governance principles. But in those first two, we're essentially doing, how many times did you guys have to do a SWOT analysis when you were an undergrad or maybe even a graduate student? So we'll look at the strengths, the weaknesses, I don't know about opportunities and threats. I mean, they're kind of embedded in this. So look, potential benefits and challenges. And then we'll talk about characteristics at the end of effective data architecture. But that last learning objective occurs, of course, at the end of this chapter, but it's really just kind of a summation of what we've talked about inside of the chapter. All right, let's start with potential benefits. And to do that, I'm going to go ahead and give you a different kind of analogy. So bear with me here for just a second. I will say this regularly in my recordings that you guys should read every day like I do. I'm a voracious reader. I read all sorts of things. I read lots of mystery books. I need mystery and murder and blood and all those kinds of things. And I've read all of the Harry Bosch books. But in recent years, the author has introduced a new character, Renee Ballard. And there's a show on Amazon Prime called Ballard. And Renee Ballard is an LA detective who's been assigned to the cold murder case room. It's in the basement, and it's a great show, by the way. And so when she walks in there, you see all these shelves, and there are boxes on all the shelves. There's 6,000 unsolved cold case murders that occurred in Los Angeles over the last, 50 or 100 years. And it's her job with her team to try to solve these cases. So what I want you to do is I want you to think of each one of those boxes as an inflation box or an interest rate box or a value at risk box. And to identify the potential benefits, we have to envision this effective risk data aggregation. So when you watch this show, if you do watch it, or maybe you have watched it, I want you to think about, is it possible for those boxes to talk to each other? That's my kind of sense of what effective risk data aggregation. And the cool thing is, that in the first season of this show, Renee Ballard and her team, they actually link one case that they're trying to solve to another case. Now, they did it through lots and lots of hard work, and of course, effective risk data aggregation involves lots of hard work. But imagine if those boxes could talk to each other to identify the relationships and the correlations and the copulas and all those kinds of things. Now, of course, we're not going to rely on Hollywood to give us our sense of effective risk data aggregation. We'll rely on somebody who we like, and we respect. So the Basel Committee, they have lots and lots of statements out there. So they're defining and gathering and processing this, yes. But look at the bottom part there. This is the really good exam question. Why we do this? We do it so that we can identify risk tolerances and appetites. Then, once we identify those, then we can move on to all that other stuff that I was talking about just a second ago. So when I say the Renee Ballard, these boxes, can they talk to each other? Look at those bottom bolded points. Sorting, merging, breaking down sets of data. I mean, imagine if the inflation box could talk to the GDP box. Now, as good economists, I mean, I'm not an economist, but probably many of you guys are, you can figure out what that relationship is. However, there are parts to that relationship that may lag in time. They may be incomplete. So if you have these two boxes talking to each other, well, that's the definition of effective risk data aggregation. Now, how does this benefit a bank? So what did I say earlier? Sensitivity analysis and scenario analysis, that allows us to anticipate problems. Restore financial health. So let me go back here real quick. The Basel Committee, I think I can say this with some relative certainty. If we didn't have the stock market crash of 1987, if we didn't have the dot-com bubble and subsequent crash around 2000, and then the 2008 financial crisis, and then COVID, we probably wouldn't need the Basel Committee. But of course, these really, really smart men and women, they respond to these financial crises. So there we go, in times of financial stress. And this is super important, right? Nobody cares I shouldn't say that. Very few people care or think about how a bank is operating when everything is beautiful, right? They're lending money, people are repaying the loans. It's in those times of stress periods that's critical. So here, this risk data aggregation, what that can lead to is a quicker recovery. Yeah, do we need to worry about those banks that used to be called too big to fail back in the old days, and now they're called something else? Systemically important banks, whatever that means. And remember, there are some definitions there. Remember, over the 50 billion, over the 10 billion. I think we did that in one of the earlier recordings. And then stronger risk function capabilities. So in a future chapter, we're going to talk enterprise-wide risk management principles, where we're moving from, kind of just the silo viewpoint to, an umbrella viewpoint. And that's what the Basel Committee is talking about here, when we have these risk function capabilities inside of each silo. And that's fine. We need to know, what did I say earlier? The ATM, we need to know what that risk function is inside of providing ATM services, but we also need to know how they relate to everything else that goes into the bank. Informed risk judgments. Now, the challenges then are exactly what I was saying just a moment ago about Renee Ballard and this show. All of these boxes of murder cases, 6,000 of them. I want you to relate that to 6,000 boxes of financial data, both the external kind that I described earlier and the internal kind that I described earlier. So what are these challenges? Collection of the data, storage of the data, and then how do you take the data out of the box and perform some kind of a sensitivity analysis? All right, so the challenge is here, and watch this. So we've got a bunch there and a bunch there. So it's my estimation that these are really, really good potential exam questions. Now, I don't think that the GARP is going to say to you, banks, different subsidiaries use different data systems. What's that problem? I think what the GARP is likely to do is say in the question stem, hey, here's a scenario. Maybe it's in portfolio construction or risk weighting of those assets. And the issue is collecting or storage or analysis. What are some challenges inside of that, kind of a module? So for each one of these colors, think of this as a potential answer: inadequate data quality, complex re-engineering, the principles of the moving targets. I really like that one down in the purple because we know that the economy is dynamic and life in general is dynamic. So there's all kinds of changes going on. And so what might hold true with the tier 1 or the tier 2 today, that might be different tomorrow. So if we have this effective data aggregation, we'll be able to respond to, I don't like to think of it as a moving target because that sounds like you're kind of moving the goalpost or changing the rules. But essentially, these principles are enabling banks to respond to the dynamic changes in the marketplace. Look at the orange, one thing down there, hard to link. Go back to my Renee Ballard, can the boxes talk to each other? Yeah, of course, you don't have to read the Wall Street Journal every day like I do to know about AI and big data. And now some of these companies, they're at 1 trillion market cap, then 2 trillion, then 3 trillion, then 4 trillion. I don't even know how big that is. But of course, we need these huge data centers, and that's going to be part of that impact of the dynamic changes. Yeah, unstructured data. So we'll have some kind of inside of a chapter on things like social media, which I don't know anything about, nor do I want to know anything about. But I do know that there are individuals who use their Instagram accounts to say something like, hey, I think NVIDIA is going to increase by 10% today. So how do you process, how do you record, how do you analyze that unstructured data? Keep in mind then that there are standardization processes out there that you can take data and standardize it, much like we do in statistics when we divide by the standard deviation to get something like a correlation coefficient. So if you have data on let's suppose that you have one state who collects, let me go back to that simple ATM example, collects time in between $100 withdrawals inside of an ATM. Well, so you have one state doing it this way, another state doing it that way, and then you go to Canada and they're in Canadian dollars. And so, boy, how do you standardize that? Well, you got to convert. You have to do all sorts of interesting things to be able to make those kinds of comparisons. And then operational flaws. Remember, GARP is really big on operational risk, which I'm paraphrasing here, is just, failed processes, inadequate processes, people or systems or any of those kinds of things. So even if we have this strong risk data aggregation, you can have operational risks that can cause failures. Now, one good question is this stuff here that I was just talking about, kind of identify the specific challenge. And then what are the consequences of some of those failures, but also using data that doesn't fit in with the 14 principles that we'll talk about here in just a second. All right, so using poor quality data. Of course, suppose we do some kind of a sensitivity analysis to come up with a range of expected shortfall, and our data is incomplete, it's not accurate. Some of it's in terms of dollars, some of it is in terms of Japanese yen, some of it, and we come up with an idea of expected shortfall, and we say, oh my gosh, let's make this decision, but that decision is completely wrong. It's kind of like George Costanza on Seinfeld. So think about George. He says every decision that he's ever made has been wrong, so the opposite has to be right. So think about this poor quality data as George George making all of the poor decisions in his life. So there we go, delayed or misinformed decisions, vulnerability, missed risk concentration. So that goes back to the silo viewpoint. When we have this discussion on enterprise-wide risk management, we'll see the importance of correlations and copulas between and among all of those different silos. And then the bottom there, 1, fines, penalties, non-compliance due to changes in regulations. But that goes back to what I was saying just a minute ago. Breakdown and identifying connections. So Renee Ballard's, those 6,000 boxes, they can't talk to each other, right? So what we need to do as good risk managers is to come up with a mechanism under which those boxes can talk to each other so that we can identify the connections. So make sure you understand that when the chapter uses the term connections, it's talking about relationships and correlations and all those kinds of things. Amplification of losses, loss of stakeholder confidence, threatening financial stability. All right, so that's that part was maybe one good question, maybe 2 good questions inside. Now remember, this is 20% of your exam, so 20% of 100 is 20 questions. So we've got, what are there? 11 chapters inside of this part 1. So 2 questions from each chapter. So that first question is going to come from there. Yes, maybe, I don't know. But at least 1, if not 2 of the questions, gosh, and maybe even a third question will come from these principles here. So remember what I said about the Basel Committee is that their importance increases every time we have a financial crisis. And so that group comes up with, better ways to handle risk and risk assessments and sensitivity analysis and all those kinds of good things. Now, I'll also warn you that there are 2 chapters at the end of this section on historical risk events. So if you look at that middle teardrop point, main reason for the failure, lack of aggregated risk data and bank-wide risk analysis capabilities. So you might be thinking to yourself, okay, that happened a long, long time ago, but GARP is going to ask you questions about history, and clearly they're going to ask about the 2008 financial crisis. I mean, they're probably not going to ask you about the 1929 stock market crash or the tulip bulb mania in Holland back in, I don't even know what year that was, 1750, 1825, whatever year that was. But so, the 2008 financial crisis, that's important. So look at that third point there. Stronger corporate governance principles, all part of the pillars that we know about value at risk and expected shortfall. We've done a little bit of that in the past. We'll continue to do that in the future. All right, so governance, what does this mean? Key governance principles. Principle 1 is governance, which just means that we've got the board of directors and then the senior executive leadership team. And so those 2 groups, they have to work together to come up with some risk appetite statement, with some sense of a risk culture, with some idea of passing along all the way down, top to bottom, and we'll do top to bottom here in just a little bit, top to bottom all the way down to the newly hired college graduate student, in which everybody starts thinking about risk and how to identify risk and quantify risk and manage the risk. So that governance is super important. What does that mean? Yeah, of course, there's got to be some documentation. We need to have it independently reviewed. Remember now, the board of directors consists of lots and lots of men and women who are really, really smart, but they're not completely smart. They don't know everything. So let's not worry. Let's not forget about the importance of getting this independently reviewed. Priority of senior management, risk data, fully embedded within the risk management framework. So that's what I was saying about the top to bottom, top down. I like this last one here. Beware of a question that sounds something like, hey, according to that principle 1, this bank has developed fully documented governance principles. However, it's not including the such and such, like maybe the derivatives group, because the new group was just formed and they're not really making too many decisions, and they only have less than 1% of the assets of the business, and et cetera, et cetera. So GARP is really good at kind of setting you up to lead you down the wrong path. So don't be fooled by an answer that sounds reasonable, like, okay, we're not going to do this because of this reason. No, that's the signal that's the correct answer. Think of data architecture and data infrastructure as those Renee Ballard 6,000 boxes, as if they could be architecturally, is that a word, formed. So instead of 6,000 boxes that are sitting there independent of each other, you've got boxes that are open, and you have data flowing out that forms something along, let's just call it a wall. And you can see all of this, and there's going to be different groupings and subheadings so that Renee Ballard or the chief risk officer can look at this board and reach in and grab something and say, hey, this is important. All right, so what's important about data architecture? So we need to find people who know what they're doing, right? It has to have a robust IT system. Look down at the bottom here. So there's no doubt, let me go back here real quick. There's no doubt that taking the information out of the boxes. Now, of course, it's not murder information. It's information on GDP and exchange rates and oil prices. Putting it on the wall, that's not cheap. It doesn't take just one day to do it. So it's very expensive. So as good organizations do, the Basel Committee is well aware of marginal costs and marginal benefits. Now, they do say over time or in the long term, so that goes back to our corporate finance kind of discussions where we talk about net present value. So essentially, the Basel Committee saying is this has a positive NPV. It just might take a while for those positive cash flows to materialize. All right, principle 3, accuracy and integrity. And by the way, when I took part 1, I don't remember memorizing every one of these 14 principles as principle 3 or 4 or 5. I mean, I had them all memorized, but gosh, I probably couldn't tell you if it was 4 or 6. So that's my advice here. Make sure you memorize the 14, but I don't think you'll be tested on. Which of the following is principle 3? That just doesn't sound like a meaningful kind of a question. All right, so accuracy and integrity. So these are two separate issues. I mean, they're related. We want to have accurate data, but we also want to have data that has a high level of integrity, meaning that, we could go out and say, okay, we see inflation from the Wall Street Journal is 2.1%. So we get that from the Wall Street Journal, but is that data, does it have a high level of integrity? And the question then is, well, how did the Wall Street Journal come up with that 2-point number? And we could go interview the Wall Street Journal and say, how did you come up with it? And suppose some person says, oh, I made it up. Well, so we have to rely on the reputation of that, of the source of that data. So make sure that it can be accurate, right? We got it out of the Wall Street Journal, but where did it come from? What is the source? So make sure that you identify those two. And there we go. Principle 3, it should be reliable. There should be controls. We should establish a single authoritative source. Now, the integrity thing also means that when we use the data, that we're going to use it for the purpose of whatever our purpose is. In this chapter, we're calling it risk reporting, but we could use it for a variety of things. So lots and lots of people ought to be able to, all right, so you're thinking of this board out here with all the 6,000 boxes, and there's all that data on the board. So you should, you don't have to have a key. It's not like the nuclear thing where you have to have 2 keys to do it at the same time. Just that everybody should have a key so that they can make certain that that data is being used, and then you can go back and verify accuracy and integrity and all those kinds of things. So of course, we're going to manually input and export data, but we're also going to automatically do it. Strike a balance. That's probably marginal cost, marginal benefit in there. Monitor and improve. Yeah. Fully documented, robust controls. Definition should be consistent across the bank. That makes a lot of sense to me. When I wrote my dissertation 100 years, there was no such thing as automated data entry. I had to punch away by hand. That was no fun. Of course, the data ought to be complete. If we have let's say monthly data on inflation and we miss January and June and August of the year 2020 and 2019 and 2011, then it's not complete, right? Now, what GARP wants you to be able to do is make certain that when you look on this board, that you can see that there are different ways to categorize all of this data. So notice up and above what the Basel Committee does: business line, legal entity, asset type, industry region, or any other groupings that we can come up with. Now here's a really good question. You ready for this? This goes along with what I was saying earlier, that when we have a scenario in a question stem where GARP will say something like, all right, here's a bank, and it believes that it is complete. However, it has some kind of a special purpose vehicle that's over there, and the special purpose vehicle is not very important, so therefore we're not including that. So there's a question where you need to know that a special purpose vehicle, that's off balance sheet financing, and even though the question might make it sound like that special purpose vehicle is not important and it's okay to exclude it, well, it's not. Make sure that it's complete. If it's not complete, explain the reasons, and those reasons ought to be pretty good. But special purpose vehicle and other off-balance sheet stuff should be included. Timeliness, of course, if we're going to perform sensitivity analysis and use inflation as an input, we ought to use the very current rate of inflation instead of using 7 months ago. That doesn't make any sense at all. So timeliness also. All right, so we had to pick that and make certain that we have the most recent data. But then we need to also be able to respond to the dynamics of, well, look at the examples we have there: operational risk indicators, trading exposures, counterparty credit risk. So we need to be able to make certain that in our sensitivity or scenario analysis that we have timely data, but also data that is reflective of that dynamic environment. Think about if we did this on I'm going to pick a day because I can't remember, March 10th, 2010. Suppose we were doing sensitivity analysis and we used data from March 1st, and that data didn't include the first couple days of COVID where stock markets and other markets were crashing, right? So this goes back to kind of like related to the integrity issue as well. Adaptability, of course, flexible and adaptable, those pretty much mean the same thing. Now, accuracy, we did accuracy back here. Where do we do this? So that was accuracy and integrity. Here, the separate form of accuracy means what are we doing? Taking this data and producing a report. That report should be accurate as well. Now, notice the second diamond point. Of course, we can make approximations, and we need to just explain those and just say, hey, you know what, this is, we had to approximate the producer price index because of the following reasons. Comprehensiveness, you guys have seen me do this before. I tell my students this all the time. We need lots of breadth and we need lots of depth. So those are the two dimensions of comprehensiveness, which could mean lots of things as we're looking at the board. So we're looking up this on this board, and we're seeing different divisions or different asset classes, and we want to make sure that there's all the breadth and depth that we need. Clarity and usefulness. When we put together a report, we would like to have the report to be able to be read and understood. There's an old show that I watch pretty regularly these days called Fred Sanford and Son, and Sanford regularly looks to somebody who comes into his junkyard and says, "In English, please," because he couldn't understand what, not that they were speaking a different language, but that they were just talking differently. So good old Fred Sanford. Frequency, this is different. What did we do back here? We did timeliness there. So frequency here is different than timeliness, although they sound a little bit alike. How often do we need to put together a report? Do we need to do it every day, every month, every year? Every year is probably not sufficient. Every hour, probably don't need an hour. But going back to that flexibility issue and adaptability, we need to be able to produce a report in a timely manner, but we want to have a set time frame under which those reports are released so that we can distribute them to all those parties out there who need to read it. And then GARP is very big on this. You'll learn this throughout part 1 and part 2, that once you do the report, then it's not the end of the story. The end of the story, I mean, there's really no end of the story, but we need to make sure that we monitor and evaluate and review. So there's the principle 12 is review, and then based upon that review, what kind of actions? Okay, hey, you did really well in this. This was that SWOT analysis that I was telling you about. What are the weaknesses? What are the opportunities? What are the threats? And that's in these, supervisors trying to figure out what worked and what didn't work. And then we need to cooperate with other relevant supervisors. So this means not only coordinating with the different silos inside of the bank, but also outside of the bank. All right, this last learning objective is really just a summary of what we've been talking about for the last, 30 minutes or so. So if you look at these words here, describe characteristics, accuracy, completeness. So we've talked about all of those kinds of issues, and this is what GARP is trying to promote, including things like quality controls, which we didn't spend too much time on, but that simply means that, hey, you know what? If we change the asset allocation of a portfolio and we did it at 10 o'clock on September 5th, well, then we need to record that, and we need to have someone document that, and we need to have someone go by and verify that. Strong oversight down at the bottom. All right, accuracy and precision, clarity, comprehensiveness, frequency. So these are all effective risk reporting practices. Scenarios, distribution, and dynamic. And that takes us through these 4 learning objectives. So I'm hoping that you agree with me that those key governance principles, I mean, that sounds to me like if there are 2 questions coming from this particular chapter, at least one is going to come from those 14 principles. So once again, just make sure you memorize those 14 principles, be able to find their marginal costs and their marginal benefits. And then maybe the relationship between, and this is why I said this earlier, CAPM to APT, to using that data, what are those challenges there? Now, what I would like for you to do, what I would like to say is, hey, I want you to go look at the 9 questions at the end of this chapter. But I promise you, when you look at them, you're going to say, oh my gosh, I hope the exam looks like these questions. I bet it doesn't take you 5 minutes to do those, maybe even less, because there's a handful of true-false questions in there, and the answers are super obvious. But anyway, go ahead and spend a few minutes doing that, just to remind yourself and to give yourself confidence that you know what's going on inside of this chapter. So hey, that was a good chapter. Did I linearly link CAPM, APT, and effective data aggregation? So I hope you remember the boxes, And I hope I don't get anything for recommending Bosch or Ballard, but my wife and I enjoyed those. So anyway, have a great day. Thanks for watching.